Hi everyone, and welcome again to Nettle, the go-to place to learn about business, finance, economics, and much more. Please don't forget to subscribe to our channel and click that bell notification button below so that you never miss fresh videos and tutorials you might be interested in. Many thanks to our current Patreon supporters and YouTube members for making this video possible, and we'd also greatly appreciate if you consider supporting us as well. So please check the link in the description or click the join button below for more details. My name is Sava, and today we're investigating the fundamental concept that bridges the gap between portfolio management, modern portfolio theory to be precise, and asset pricing, which is the concept of securities market line, capital allocation line, or capital market line, and those are the foundations for the derivation of the capital asset pricing model, or CAPM for short. Today, we'll investigate the relationship between efficient portfolio frontiers and the capital allocation line or capital market line, and show how you can use several assumptions to derive the CAPM and the concept of the market portfolio from there. To illustrate our today's exercise, we've got 10 years worth of daily data for 10 well-established US stocks, as well as the S&P 500 index, which is the go-to proxy for the total US stock market. We'll retrieve daily returns by just dividing prices today by prices yesterday and subtracting 1, enforcing it throughout all of our 10 stocks plus the market index and throughout our 10 years worth of daily data. We'll be able to calculate the betas and the expected returns using the logic of CAPM. So we can calculate the slopes of each of the stocks. So for example, for Apple, we calculate its slope against the S&P 500, and we can lock S&P 500 here because the benchmark stays the same for all 10 stocks. We can see that Apple has a beta of slightly higher than 1, meaning that Apple is slightly riskier than the market, and we can see the selection of betas here. We have got defensive stocks such as Walmart or Pfizer. We have got pretty aggressive stocks such as Delta Airlines or Goldman Sachs, and we've got stocks with beta exposures of around 1 such as Disney and Caterpillar. For the expected return, we'll need to know the risk-free rate, which is around 4% as of October end 2022, 4.05% to be precise. And to know the market return, we can simply extrapolate 10 years worth of historical data for the market return. So we divide the index value at the very end of our sample by the index value at the very start of our sample, raise it to the power of 1 over 10, as we've got 10 years worth of data, and subtract 1. We see that the market return is around 10%, which is very reasonable for stock markets to return that amount on average over long time periods. Generally, you have this market return in between 8 and 12%, so that's quite a realistic figure. And for expected returns, we just need to add on top of the risk-free rate that stays the same throughout our stocks, their betas that we don't need to lock as they vary from stock to stock, and times by the market risk premium, which is market return locked minus the risk-free rate locked. And that's expected returns done with. We can see that the least risky stocks, such as Walmart, have the lower expected returns, reflecting the low risk premium that they have to compensate investors with, given their low beta exposures. And the highest returning stock, the highest expected return, is occurring at Delta Airlines, which has the highest beta in our 10 sample stocks. Now, for the efficient portfolio frontier construction, we need the covariance matrix, and we'll be using the Merton matrix model to retrieve the unconstrained efficient portfolio frontier. So here, we'll use the index method for the covariance matrix. So we use covariance.s function to calculate covariances, and then we use the index function to flexibly assemble it for all of our sample stocks. So we refer to the first line, the first row of returns of all stocks except the index. Then we refer to the indexing variable over here, the Y12 variable, and we lock the column here as we want it to change as we drag it down, but we do not want to change it as we drag it across. Then we need to refer in a very similar fashion to the bottom line of returns, the bottom row of returns here, effectively selecting the stock that we want to work with and referring to the same index variable. Next, we just need to specify our second stock that will be specified using the indexing variable at the top row here. So we can simply copy this function and change the reference variable, the index variable, to Z11, And here we need to lock the row and not the column, as we want it to change as we drag it across, but not as we drag it down. And finally, to annualize our covariances as we deal with annualized returns here, we need to multiply by 252, as covariance scales linearly, and there are 252 trading days in a year on average. That allows us to retrieve all of our covariances quite efficiently. Again, we can drag it across and down. And for the Merton matrix model application, we can simply calculate the matrix inverse of the covariance matrix, which would play a central role in our efficient portfolio frontier parameters. We can see that our inverse matrix stays symmetric, and we'll use that in calculating the constants that specify our investable universe and the relationship between risk and return for efficient portfolios. To do that, we need to specify two vectors, which is the E vector, which is a unit vector, meaning that it's a vector of ones that has the same number of entries as the number of stocks. So we'll have 10 ones. That would be the E vector, the unit vector. And the R vector is the vector of expected returns that we can plug in from the top. And next, we can calculate the H vector and the G vector, which in terms of the Merton matrix model can be interpreted as being the risk minimizing and the return maximizing vectors, if we speak very roughly. So for the H vector, we'll need to matrix multiply our unit vector E by the inverse covariance matrix, which we've got over here. That constructs the H vector that has 10 entries, just as the number of stocks we've got. And then to calculate the G vector, the return maximizing vector, we can multiply the return vector R on the right by the inverse covariance matrix as well. Now we can use those vectors to construct four constants that would characterize our efficient portfolio frontier, mainly the relationship between the risk and return. So alpha would be the sum product of the E vector and the H vector. Beta, and this beta is different from the market beta, and again, this notation is quite unfortunate, but this beta is the sum product of the E vector and the G vector. And finally, the gamma constant is the sum product of our R vector and our G vector. Delta is the normalizing constant that allows to preserve scale, and we need to calculate it using alpha times gamma minus beta squared. And a good sanity check is to check that whether delta is positive. Delta is positive here, so it means that we have not made any glaring mistakes and our efficient portfolio frontier would work. If delta is negative, we need to double check our assumptions, whether we constructed the covariance matrix correctly, whether we've calculated the returns correctly. But here we can see that our model will work. And now we can actually construct our efficient portfolio frontier by leveraging this relationship between expected return and risk at the frontier. Here we have got our expected returns that we would like our portfolio that we seek to assemble to have, and our risk. And this relationship is fully determined by the four constants that we've just calculated. So the risk of a portfolio with a specific value of return would be the square root of alpha, and want to lock it as it stays the same throughout the frontier, times our desired return squared, minus 2 times the beta constant over here, times the value of the desired expected return, plus gamma, locked still, and divided by delta. And again, we need to lock it. And then we close the parentheses and retrieve the value of risk throughout the various values of expected returns. And here, keeping in mind the range of expected returns we've got for our stocks, I decided to go in increments of 10 basis points from 0% up until 15%. And we can see that we have got our efficient portfolio frontier appearing on the chart. Now, what we seek to accomplish is to construct a tangency portfolio as well as the capital market line or capital allocation line. The idea here that if we introduce a risk-free asset into our investable universe, and we kind of do here by specifying that we've got a risk-free rate, a risk-free asset, which is a US government bond that yields 4.05% per annum risk-free. And that means that our feasible set of investments that currently, if we just judge by the frontier, is contained within this orange line, which is to the right of the orange line. This is meaning that we cannot achieve, for example, if we look at 30%, we cannot achieve a return that's higher than around 13.6% for a risk of 30%. Alternatively, we could not achieve a risk lower than 30% for a portfolio that's returning around 13.6%. So the feasible set is contained to the right of this orange line. But if we introduce a risk-free asset, then we can combine or mix, in terms of allocations, our risk-free asset that would have a risk of 0, so it would be somewhere here on the y-axis, and a return of 4.05% with any feasible portfolio we have got in our hands. So with any portfolio on or within the frontier. And given the fact that the risk-free rate is risk-free, meaning that it has variance 0 and it has got correlation 0 with any of our risky assets that are represented by the orange frontier, we can represent the mixture of those two as a line, straight line, on the risk-return plane that would connect the two. And it means that the most efficient, the most optimal way of constructing such a portfolio would be to look at various combinations and see which has the highest slope of this particular straight line. Why? Because if we envision various lines that pass through the risk-free rate, risk-free asset on the y-axis somewhere, and through some of the feasible portfolios that we have constructed, the slope would tell us how much extra return do we gain per unit of risk taken. And we want our risk premium, this compensation per unit of risk on top of the risk-free asset, to be the highest. And we can easily see that if our slope is too high, we would not be able to find any feasible portfolios with such a slope, as the feasible set is quite contained. However, if the slope is too shallow, we would not be obtaining the best risk premium, the best return per unit of risk possible. And the boundary case, the optimal case, would be when the line barely touches it is tangent to the feasible set or the efficient portfolio frontier. And for that, we have got a closed form expression allowing us to retrieve tangency return from our constants that describe the portfolio, they describe the investable universe, as well as the risk-free rate. So the tangency return for our investable universe would be gamma minus beta times the risk-free rate divided by beta minus alpha times the risk-free rate. And we see that the tangency return in our case is 10.47%, which is quite close to the market return, which has some interesting implications that we'll discuss next when we'll discuss the link between capital allocation line and CAPM. And then we can use the same function as here to retrieve the risk of this tangency portfolio. So we'll calculate the square root of alpha times tangency return squared minus 2 times beta times tangency return plus gamma and divided by delta. That constructs our tangency risk at 18% approximately, which again is quite representative of the stock market at large. And now finally we can know the slope of our line, which is basically the risk premium on top of the level of risk that we take. So here is the risk premium, our tangency portfolio return minus the risk-free rate, and we divide it by the risk of the tangency portfolio to get the slope of the capital market line at 0.3564. This can also be interpreted as the maximum Sharpe ratio obtainable using this investable universe. If you would like to know more about the Sharpe ratio, please check this video out. And it's quite intuitive that our investors would want to obtain the highest Sharpe ratio possible, the highest, again, excess return per the unit of risk taken. Now we need to actually envision what this portfolio looks like. Are allocations reasonable? what do they correspond to? Maybe there are some short selling positions there which can serve as a problem for some investors. And to do that, we'll construct our allocations using lambda and mu, which allow you to construct portfolio weights from any target level of return you like, this R asterisk here, and it uses the H vectors and the G vectors as weights multiplied by the lambda and mu constants. So for the lambda, we subtract from gamma beta times our target return, which here is the tangency return. We seek to establish the tangency portfolio weights, divided by delta. And for the mu, we first calculate alpha times the tangency return minus beta and divide by delta. And finally, we can assemble our tangency portfolio by multiplying lambda times our H vector and adding mu times our G vector. And we have got our portfolio assembled. It sums up to 100%, meaning that we haven't made a mistake anywhere. And it has positive allocations and quite reasonable allocations into every single of our stocks, with the highest allocations being Google and Apple. Goldman Sachs is a close third, the lowest allocation being Delta Airlines. All of them are positive, and this is a portfolio that many investors would consider reasonable to invest in. And now we can actually calculate our capital market line and see what the tangency is achieved, even visually. So here we'll look at various levels of risk, and then we use the logic of the slope. So the return on the capital market line would be directly dependent on the risk-free rate and the slope, extra return per unit of risk taken. So the return at the capital market line is the risk-free rate plus the risk taken times the slope of the line, or the maximum obtainable Sharpe ratio. And then we can enforce it throughout and have a look at the chart now. We have got the capital market line that indeed just touches the efficient portfolio frontier in one point, which corresponds to the optimal scenario, the maximum Sharpe ratio that is still feasible given our feasible set of risky assets and given our risk-free asset. And what is even more illustrative is that we can change our input parameters. For example, we can reduce our risk-free rate, let's say to 1%. That would make our capital market line a little bit steeper. Or we can increase it to something like 7%, and we can see how much shallower, how less steep it becomes. But let's return to 4.05% and discuss the underlying concept behind the capital market line and how it allows to derive CAPM. First of all, CAPM assumes that all investors have the same information available in line with the risky assets that are in the investable universe. All investors would have the same expected returns and the same estimated covariances that would directly translate into the same shape of the efficient portfolio frontier that those investors would use in their judgment. What is also important is that the investable universe, these stocks, are the same for all investors. So no investor has access to international capital markets, for example, in our case, or no investor has access to any risky assets apart from these 10 stocks, which is, again, quite a stringent assumption, but it is required to derive CAPM nonetheless. Next, we need to assume that all investors have the same risk-free asset, which ultimately means that all investors are based in the same country and invest in the same currency. That would be a US risk-free rate, so it would be relevant for US investors. But what is most important is that we need to assume that all investors have the same investment horizon. For example, this is a 10-year risk-free rate, and this return would truly be risk-free only if you buy the government bond now and hold it until maturity, as the prices of government bonds and yields change across time all the time. However, you should not care about it if you plan to hold the government bond until maturity, as the only source of risk there, if you plan to hold until maturity, is sovereign defaults. And it's quite unlikely, and some would say probability zero, that the US government would default on its debt. So this is why we have to assume that the investment horizon of all investors is the same. And if it's indeed the case, and we additionally assume that there are no transaction costs or taxes that could skew these expected returns and the frontier as well, if we assume that these are the clean figures that everybody plots into their optimizers, then all investors would choose a particular point on the capital market line as their optimal allocation. Some investors would be so risk averse that they would completely invest in the risk-free asset and not consider any risky asset whatsoever. Some investors would go for a mixture of risk-free and risky assets. So, for example, choose a 60-40 allocation, which is quite prominent in practice. Some would just go for the risky asset and pick the tangency portfolio, and some would leverage and pick a point further on the capital market line beyond the tangency point, which would be interpretable as investors short selling government bonds to fund additional purchases of the risky asset. And this is where the final assumption comes from, that would require all investors to be able to short or long, in that matter, any of the risky assets as well as the risk-free asset. And if all these assumptions are true, then it does generate some very substantial implications for investing. It would mean that the only way any investor has any exposure to risky assets is the proportion of their portfolio that's allocated to the tangency portfolio. So any investor that invests in risky assets whatsoever would do so in weights proportional to those weights of the tangency portfolio. And this is where the link to the market portfolio and CAPM lies. If all the arguments we have outlined so far are true, then there is no way these stocks would be funded in a different proportion, which means that their market capitalizations need to be in exactly those ratios. And this is why this can be interpreted as a market portfolio. For example, we can deduce from here that the market capitalization of Disney should be roughly 3 times the market capitalization of Delta Airlines, because if an investor puts $3.45 into Delta Airlines, they automatically put $9.63 into Disney. And as all investors are on the capital market line, and the only way they invest in risky assets is by mixing the tangency portfolio with the risk-free asset somehow, thus this would hold. And this is how the market portfolio comes into the Black-Litterman model, where you actually vary expected returns to match those tangency weights to the market portfolio weights, which are retrieved from market capitalizations. And this is why the tangency portfolio, if we believe in CAPM assumptions, that is, same information about expected returns and covariances, which are not skewed in any direction by transaction costs or taxes, that the risk rate is the same for all investors, meaning the same investment horizon, and that you are allowed to long or short any asset available, well then, the tangency portfolio is the value-weighted market portfolio. And this is all there is about the link between the Merton matrix model of the efficient portfolio frontier and the capital market line, the derivation of the tangency portfolio and the line itself, as well as the fundamental theoretical link between portfolio management and asset pricing that constructs the tangency portfolio as the market portfolio for the purposes of CAPM. Please leave a like on this video if you found it helpful. In the comments below, I'm eager to see any further suggestions for videos on business, finance, or economics you would like me to record. And please don't forget to subscribe to our channel and consider supporting us on Patreon. Thank you very much, and stay tuned.